What if I told you the most powerful weapon in the world isn't a missile, isn't a cyber attack, isn't even an army? What if it's a currency? For nearly a century, the US dollar has been the invisible backbone of global trade. Oil is priced in it. Debt is issued in it. Nations store it in vaults as protection against chaos. But here's the unsettling question almost no one wants to ask. What happens if the dollar loses its reserve status? History has seen this before. Powerful empires once controlled the world's money. They believed their dominance was permanent. They were wrong. And when reserve currencies fall, the fallout is never gentle. Today, we're going to trace the full arc, the origins, the rise, the breaking point, the fallout, and the failed fixes. And by the end, you may see the modern financial world very differently. Because history doesn't repeat perfectly, but it rhymes. Let's go back to the beginning. In the 19th century, the global. Welcome to its financial history, too. Reserve currency wasn't the dollar. It was the British pound sterling, issued by the vast empire of the United Kingdom. At its peak, the British Empire controlled nearly a quarter of the world's land and population. Global trade flowed through London. Nations held their reserves in pounds because Britain was stable, powerful, and dominant at sea. Sound familiar? Reserve currencies don't become dominant by accident. They rise because of trust, military strength, financial depth, and trade dominance. In the late 1800s, Britain checked every box. But cracks were forming. World War I drained Britain's finances. To pay for war, it borrowed heavily, especially from the rising power across the Atlantic, the United States. Then came World War II. By 1944, as the war was nearing its end, representatives from 44 nations gathered at a small hotel in New Hampshire for a meeting that would reshape the global financial system, the Bretton Woods Conference. The decision they made changed everything. The US dollar would become the world's anchor currency. It would be backed by gold at $35 per ounce. Other currencies would peg themselves to the dollar. And America, with its massive gold reserves, industrial power, and political stability, would sit at the center of global finance. The British pound's era was over. The dollar's rise wasn't just about economics. It was about power. After World War II, the United States held nearly two-thirds of the world's gold reserves. Its factories were intact. Its economy was booming. Its military was unmatched. Trust flowed naturally toward the dollar. But here's where history gets interesting. Reserve status creates privilege and temptation. Because when the world uses your currency, you gain extraordinary advantages. You can borrow cheaply. You can run trade deficits without immediate collapse. You can print money that other countries willingly hold. This phenomenon later became known as the exorbitant privilege. But privilege breeds pressure. By the 1960s, America was spending heavily on social programs at home and war abroad. Dollar flooded the global system. Foreign governments began to worry. Were there really enough gold reserves to back all those dollars? Countries like France started demanding gold in exchange for their dollars. And then, in 1971, President Richard Nixon made a dramatic decision. He ended the dollar's convertibility into gold. The Bretton Woods system collapsed. The world moved to a fiat system, currencies backed not by gold, but by trust. Many predicted the dollar would fall immediately. It didn't. Instead, a new system quietly formed. In the 1970s, the United States reached strategic agreements with major oil producers, particularly Saudi Arabia. Oil would be priced in dollars. In return, the U.S. would provide military protection and political support. The petrodollar system was born. Every country that needed oil, which was nearly every country, needed dollars. Demand for the dollar remained strong. But here's the uncomfortable truth. Reserve currencies rarely collapse overnight. They weaken slowly, then suddenly. History shows a pattern. First, dominance. Then, overextension. Then, debt. Then, loss of confidence. Let's look at the numbers. In 1999, roughly 71% of global foreign exchange reserves were held in US dollars. Today, that number has fallen to around 58 to 59%, still dominant, but clearly declining. Meanwhile, nations are diversifying. Gold purchases by central banks have surged to multi-decade highs. Countries are conducting bilateral trade in local currencies. Financial alliances outside U.S. influence are expanding. Organizations like BRICS, originally including Brazil, Russia, India, China, and South Africa, have openly discussed alternatives to dollar dominance. Is this the breaking point? Not necessarily, but the parallels are unsettling. Consider Britain again. By the early 20th century, it was heavily indebted. It relied on foreign capital. Its empire was expensive to maintain. Industrial competitors were rising. The United States today carries over $30 trillion in national debt. Interest payments alone are consuming a growing share of federal revenue. Political polarization creates uncertainty. Sanctions policies have pushed some nations to seek financial systems outside U.S. control. Here's the cause and effect chain that history warns us about. When a reserve currency nation runs persistent deficits, it exports its currency to the world. When too much currency accumulates abroad, confidence weakens. When confidence weakens, diversification begins. When diversification accelerates, borrowing costs rise. When borrowing costs rise, debt becomes harder to sustain. And when debt becomes unsustainable, the system strains. If the dollar were to lose reserve status, what would the fallout look like? First, borrowing costs in the United States would likely rise sharply. Foreign demand for U.S. Treasury bonds helps keep interest rates lower than they otherwise would be. If that demand falls, rates rise. Second, inflation pressures could intensify. The U.S. benefits from importing goods in its own currency. A weaker global demand for dollars could mean a weaker dollar, making imports more expensive. Third, geopolitical influence would shrink. Financial sanctions work largely because the dollar dominates global payment systems. Without that leverage, political power changes. But here's the twist. There is currently no single obvious replacement. The euro has structural challenges. China's yuan faces capital controls and limited convertibility. Gold cannot easily handle modern transaction volumes. A multipolar currency world may emerge instead. Fragmented, less stable, and more complex. And that fragmentation itself could create volatility. History suggests reserve transitions are turbulent. When the pound gave way to the dollar, the world experienced 2 world wars and a global depression in between. Currency transitions don't cause wars directly, but financial instability amplifies political tensions. Now here's the part many miss. Reserve status isn't just about economics. It's about trust. Trust in institutions. Trust in rule of law. Trust in political stability. Trust in military protection. Trust that debt will be honored without devaluation. As long as that trust remains strong, the dollar remains resilient. But if trust erodes gradually, then suddenly, history tells us what happens next. Failed fixes often make things worse. Britain tried to restore the gold standard in the 1920s at pre-war exchange rates. It overvalued the pound, crushed exports, and deepened economic pain. The attempt to restore past glory accelerated decline. If a reserve nation responds to pressure by tightening too aggressively, printing too recklessly, or weaponizing its currency excessively, it can unintentionally speed diversification. We are now in a world where central banks are stockpiling gold at record pace, where digital payment systems are developing outside traditional channels, where geopolitical blocs are forming. Are we witnessing the early chapters of a reserve transition? It's possible. But history also shows that dominant currencies often last longer than critics expect. The dollar's network effects, deep capital markets, liquidity, legal protections, and global integration are immense advantages. Transitions take decades. The real danger isn't a dramatic overnight collapse. It's complacency. So what are the 3 key takeaways? First, reserve status is earned through strength and trust, but it can be weakened by overextension and debt. Second, currency transitions are slow, messy, and often accompanied by economic or political instability. Third, the absence of a clear successor doesn't guarantee permanence. It may simply delay change. The dollar may remain dominant for years, possibly decades, but history warns us that no currency holds the throne forever. The British pound once seemed untouchable. So did the Spanish real. So did the Dutch guilder. Power shifts. Confidence shifts. And when it does, the financial world reorganizes itself, often painfully. So here's the open question. Are we watching the early signals of another historic transition, or just another cycle of fear? The answer will shape not only markets, but geopolitics, living standards, and global stability for generations. If you found this breakdown valuable, subscribe for deeper historical and financial analysis. Because understanding the patterns of the past may be the only way to navigate what comes next. And in a world built on trust, the real question isn't whether a currency can fall. It's whether we'll recognize the warning signs before it does.